Ever wondered who's calling the shots on all things dough? That's where central banks strut onto the scene. Picture them as the financial puppet masters, the big cheese of money in a country. Their main gig? Managing the country's money supply and monetary policy. Basically, they control the flow of cash and set the rules for how money is used. Think of it like this. Imagine the economy as a giant swimming pool. The central bank is the lifeguard, making sure there's not too much water, inflation, or too little recession. They do this by controlling the money tap, adding or draining water to keep things balanced. They're like the referees of the financial system, blowing the whistle on reckless behavior and ensuring fair play. They're the ones who set the interest rates, influencing how much it costs to borrow money. And if things get really hairy, they're the lender of last resort, throwing a lifeline to struggling banks. These financial bigwigs may seem mysterious, but they play a crucial role in keeping our economies afloat. So buckle up as we dive deep into the world of central banks, exploring their powers, their functions, and why they matter to you. One of the central bank's biggest foes? Inflation, that nasty beast that makes your money worth less over time. You know, when that $5 latte suddenly costs $7.50, yeah, that's inflation rearing its ugly head. Central banks are like inflation fighters, armed with their trusty weapon interest rates. When inflation starts to rise, they raise interest rates, making it more expensive to borrow money. This slows down spending and cools down the economy, bringing those price tags back down to earth. But it's a delicate balancing act. Raise rates too high and you risk sending the economy into a tailspin. Too low and inflation runs rampant. It's like trying to walk a tightrope while juggling chainsaws. Tricky but crucial for keeping the economy stable. Remember those interest rates we just talked about? Well, they're a pretty big deal. They're like the price tags on borrowing money. When you take out a loan for a car, a house, or even just put some purchases on your credit card, you're hit with interest. Central banks are the ones who set the benchmark for these interest rates. If they raise rates, it becomes more expensive to borrow, which can slow down the economy. Think of it like this. If your credit card interest rate skyrockets, you'll probably think twice about that impulse purchase. On the flip side, if central banks lower interest rates, borrowing becomes cheaper, encouraging people to spend more and boosting the economy. It's all about finding that sweet spot, that Goldilocks rate, that keeps the economy humming along without veering into inflation territory. Central banks are also the superheroes of the financial system, always ready to swoop in and save the day when things go south. They're the lender of last resort, providing emergency loans to banks that are struggling to stay afloat. Think of it like this. Imagine a bank is like a swimmer who's gotten in over their head. They're struggling to stay above water, and without help, they'll go under. That's where the central bank dives in, throwing them a life preserver in the form of an emergency loan. This lender of last resort role is crucial for preventing financial panics. If one bank fails, it can trigger a domino effect, taking down other banks with it. But with the central bank standing ready to provide support, it helps to maintain confidence in the financial system and prevent those disastrous chain reactions. Central banks aren't just about managing money, they're also the sheriffs of the financial system, making sure everyone's playing by the rules. They're responsible for regulating financial institutions, setting standards, and preventing risky behavior. Think of them as the financial referees, blowing the whistle on banks that are engaging in shady practices or taking on too much risk. They're the ones who make sure banks have enough capital on hand to weather economic storms and that they're treating their customers fairly. This regulatory role is crucial for maintaining a stable and trustworthy financial system. By keeping banks in check, central banks help to protect consumers, businesses, and the overall economy from financial meltdowns.